Are you looking to build your wealth and become financially independent? Hey guys, Eric Martel here. In this video, I'm going to be talking about some wealth building habits that you should implement today, whether you have money in the bank or not. Implementing these habits will change your life and how you see the world around you. So let's get started. The number one is the importance of budgeting. A budget is the foundation of any wealth building strategy. It's important to carefully evaluate your goals, your resources, and investing in any asset class, as it will help you make better decisions and avoid costly mistakes. But without a budget, it's almost impossible to be successful in building wealth. The main benefit of having a budget is that it allows you to control your spending and allocate more money toward investments. Having a clear picture of where all your money is going helps keep track of cash flow, which can be used to increase investments or pay down debt faster. One of the most effective budgeting strategies is the 50-30-20 rule. This rule suggests that you allocate 50% of your income to essentials like housing, food, and transportation, 30% towards fun stuff like entertainment and travel, and 20% towards investment. By following this rule, you can ensure that you're living within your means while still investing in your future. Finally, keeping a budget also encourages discipline when it comes to investing. Having specific financial targets like putting away 20% of your earnings every month can help you reach financial independence sooner than expected. Next one is the power of compounding. The power of compounding is one of the most powerful wealth building strategies available. Compounding is a simple concept. You reinvest your returns so that they generate even more returns. This allows you to grow your wealth exponentially over time. To understand the power of compounding, let's take a look at a simple example. Suppose you buy a $10,000 asset today and that asset appreciates at an average of 8% annually. 10 years later, without compounding, your investment would be worth $18,000. But with compounding, your asset would be worth $21,589. That's an extra $3,000, and that is due to the appreciation that's being applied on top of previous appreciation. Compounding may seem like a small amount at first, but as time passes and more money is reinvested back into the investment, it adds up very quickly. The power of compounding is indisputable. It has helped many individuals become wealthy through wise investments and consistent contributions to their portfolio over many years. By taking advantage of compounding and investing regularly during your lifetime, you can greatly increase your net worth while achieving financial freedom along the way. The next habit is having the right strategy for you. When it comes to becoming wealthy, selecting the right investment strategy is key. There are a variety of options available, ranging from stock market investment to crypto investment to real estate. And even within real estate, there are tons of strategies to make money in real estate, and each of them work. Each has its advantages and disadvantages. And the strategy you select should be tailored to your individual goal and the resources you have available, which means that you should consider both the amount of capital you have available as well as the time you can dedicate to manage your investment so that you can be successful. In general, one of the most important factors to consider when selecting an investment strategy is to make sure that it is aligned with your goals. For example, if your goal is to achieve financial freedom by building a passive income portfolio, then you want to choose a strategy that will generate passive income. For the strategy to be successful, you will need to draw from your resources. That means that you want to have sufficient capital and have enough time available to implement this strategy. Assess your available capital, assess how much time you can spend implementing and then monitoring these investments, then decide what works best for you given these restrictions while still allowing you to achieve your financial objectives. The next habit is the power of leverage. Well, the power of leverage is an incredibly powerful tool for wealth building. Leverage is the use of borrowed money to buy an asset such as real estate with the intention of making a return on that investment. With leverage, you can increase your returns by investing more than your own capital into a certain asset. For example, if you were to purchase a property that required $20,000 of your own money and $80,000 in mortgage, and the property increased in value by 10%, then the total return would be 50% on the $20,000 that you have invested. This is the beauty of leverage. It allows you to use someone else's money to increase your returns significantly. Of course, there are risks involved when using leverage. When done correctly and managed responsibly, leverage can be one of the most effective wealth building tools out there. It allows you to multiply your return on investment while still only risking a fraction of your own capital, making it an incredibly attractive option for those looking to grow their wealth aggressively over time. The next habit is the importance of financial literacy. Financial literacy is becoming increasingly important in the world today. With more and more people looking for ways to build wealth, it's essential that you understand the fundamentals of investing. Without a basic knowledge of finance and investment, it can be difficult to make informed decisions about your money. Financial literacy gives you the skills and understanding needed to create a secure financial future for yourself. By having an awareness of how money works, you can make educated choices when investing. This could include selecting suitable investments based on risk levels, determining the right business structure, the right market, etc. Having a good knowledge base allows you to avoid costly mistakes that could set you back financially in both short term and the long term. Finally, having an understanding of economic trends also provides insight into potential opportunities or areas where caution should be exercised when making investment decisions. So next is the importance of long-term thinking. Building wealth doesn't happen overnight, so having patience is crucial. It might take several decades or longer depending on your starting capital and the amount of effort you can put towards a given strategy. Being patient, consistent, and disciplined is essential when building up one's net worth. Long-term thinking is an essential part of any wealth building strategy. While get-rich-quick schemes may be tempting, the truth is that sustainable and lasting wealth requires careful planning, long-term goals, and dedication. Taking a long-term approach to wealth building means that you don't need to wait for a downturn in the economy or a market correction to start investing. If I'm considering a short-term investment of 3 to 6 months, I need to look at the market risk. Will the interest rate go up? Will we have a recession? Unemployment going to go through the roof? But when I'm considering an investment over a 25 or even a 50-year period, the fluctuation in interest rates will have minimal impact 25 years from now. I know that my asset will be worth significantly more in the future than it is today. The next habit is don't wait for the unicorn. Investing in a unicorn or one-time big winner can be very tempting, but it's not a good strategy for long-term wealth building. Studies show that investors who try to time the market or bet on big winners often end up missing out on significant opportunities. Over time, these missed opportunities can add up to substantial amount of lost potential profits. Instead, investors should practice consistent and continuous investing over time. This means investing regularly in investments that meet their specific criteria, instead of trying to pick individual winners. Doing so increases your chance of success by diversifying your portfolio and taking advantage of dollar cost averaging. Dollar cost averaging helps protect you from buying high and selling low by spreading out your purchases over several months or even years. So regularly investing also helps you stay disciplined and focused on the long-term goal of becoming financially secure. By making regular investments over time, you are able to ride out market fluctuations while still maintaining a strong position in different asset classes. Building wealth is all about having an unwavering commitment over time and staying the course no matter what life throws at you, financially speaking. It's easy to get caught up on speculations or the promise of quick riches, but this isn't a sustainable way to build wealth or guarantee security down the road. This principle may lack the glamour of scoring big with one-time investments, but it's far more likely to yield financial stability and peace of mind in the future. The next habit is about the need to manage risk. Risk management is an essential part of any wealth building strategy. In the world of investing, there's no such thing as a sure thing, and it's important for investors to understand the risks associated with their investments before committing any money. Even when an investment seems like a no-brainer, it's always important to take into account potential downside scenarios that could arise over time. So for instance, if you're investing in real estate, you should consider the possibilities of vacancies and significant repairs needed to keep your property profitable. Understanding these potential risks can help investors be more prepared and accurately assess whether or not a given investment is worth pursuing. One way to manage risk when investing is by utilizing hedging. Hedging involves taking out offsetting positions to reduce exposure to certain types of losses. For example, if you have invested in stocks and want to reduce your risk, you can invest in options or derivatives that would profit from a decline in stock prices. Through careful use of hedging strategies, investors can minimize their losses and maximize their profits during periods of market volatility. Another effective way to manage risk when investing is diversification. Diversification consists of spreading out your investments across multiple asset classes to lower total portfolio risk and increase returns over time. Again, if you're investing in real estate, you may want to consider investing in different markets. You may also want to invest in different asset classes, single-family rentals, maybe some short-term rentals, maybe some self-storage, maybe some apartment buildings. Diversification is going to help you kind of like navigate the ups and downs of the market that are specific to an asset class. The next habit is about taking advantage of tax benefits. So one of the most effective and underutilized wealth building strategies is taking advantage of the various tax benefits available to those looking to increase their net worth. For example, there are a number of tax incentives for investing in real estate, of course, such as deductions for mortgage interest, repairs and maintenance, depreciation, capital improvements, and you also have tax deferments such as the 1031 exchange. There are also several other tax benefits available, including deductions for business expenses related to the investments and capital gains exclusion on certain types of investments. It's important for individuals looking to take advantage of the various tax benefits available to them through investing and other forms of saving to correctly record all expenses relating to these investments. So that way you can make sure that you can actually file your taxes correctly each year and take advantage of these deductions. The next habit is about maximizing your return on equity. Maximizing your return on equity is a common strategy for building wealth. Return on equity is a measure of the profit on the equity in an investment or an asset. When investing in real estate, the equity will build up over time as the asset appreciates, the loan is being paid down, and you also have an accumulation of cash flow. This will cause the return on equity to go down over time. In order to maximize your return on equity, you should consider refinancing or selling the asset to capture the equity and reinvest it for a better return. And the next habit is rebalancing your portfolio regularly. Rebalancing your portfolio regularly is an important part of wealth building. Rebalancing involves periodically refinancing to capture equity buildup on some assets, selling assets that have gained in value, and also selling assets that have underperformed. This helps reduce your risk by ensuring that no one asset is overweighted in the portfolio and allows for the maximization of returns. Rebalancing also lets you take advantage of market opportunities as they arise, since it forces you to kind of review the performance, the composition of your holdings, and then free up some equity and some cash that you can then deploy in the market. Moreover, you can use rebalancing to manage taxes, since selling gainers will cause capital gains tax, then selling losers can also offset the same capital gains. Rebalancing your portfolio regularly helps you reduce the risk while simultaneously maximizing your returns and optimizing your taxes. Well, I hope this video has given you some insight into the various wealth building habits, from leveraging tax benefits to rebalancing your portfolio. With all these tools in hand, you can now start taking steps towards achieving financial independence and creating a secure future for yourself. So don't forget to like and subscribe. And you should also check out these two videos, and see you next week.